There we go. And we can do whatever. I can edit it out or whatnot. Well, I guess I'll do an interview. How about that? Or we'll start with the thing. Hi, my name's Andy. I'm on Finding Value Finance. We kind of threw this together pretty quick just to share some information and some ideas. I've got Patrick Karim with me from Bad Charts. He has his own website, and he also has a YouTube channel. I think your YouTube channel is it Bad Charts North Star? Or
yeah, the YouTube is slash bad North Star Bad Charts.
North Star Bad Charts.
Yeah.
Okay, and we got together to talk about real estate and the implications that real estate may have on stocks, precious metals, commodities, stuff like that. And I was really interested in doing this interview because I'm interested in finding the linkage between everything. I see a lot of your charts on Twitter. Your Twitter handle is at bad charts.
Bad Charts 1. Somebody took Bad Charts. How dare they? I hope that, like, people get confused that they do add Bad Charts. I wonder how much stuff that guy's getting, because it has nothing to do with charts. The guy who has just a handle Bad Charts. But anyways, sorry about that.
No, you're good. So yeah, we were talking on Twitter. We wanted to talk about this. And you were looking at, and you noticed that the real estate prices were going quite vertical.
Yeah.
What did you see to kind of spur this?
Well, I had the, should I share my screen or fast? Won't be.
Yeah, let's do it. Let's share the screen.
I'll share mine, share my screen. Okay, here it is, guys. Don't look at my taskbar. Don't guess the games I have, guys. You're not allowed to do that. So here I just had the IYR and I had an alert that popped up, and just put that big. Well, okay, look, check even better. Is it? It's keeping moving up today. I'll just go on the Twitter because it's not too far. So here I have the, Jesus, I want to move that. Okay, here I have the IYR. So the real estate going, I had an alert. So it's breaking out right here, the black one. And then my first reflex is when something's breaking out, I want to start like building the evidence. So what's gold doing at that time? What was silver doing at that time? And just not change too many, like a scientist, like in a new experiment, you can't just put a whole bunch of stuff, you've already have your base case of evidence, and then just one step at a time, see how that stuff fits. And because I did remember that from our podcast that you did when you came on our show, you had some charts there about real estate and gold. And when real estate was going up, something was happening with gold, but I couldn't quite remember. But I still had that reflex and I put silver. And then I saw that when real estate was booming, silver had a chance also of booming. Same thing here. After a 2008 crash, they both boomed together. Even the 2015, 2016 to late 2016, they both like exploded together. And as silver's consolidated, real estate's blowing up. So I'm wondering if that's a healthy environment for gold and silver to continue once they consolidated. And right here, I have my 7-year rate of change that I grabbed from a Blackbeard research report, which I think he told me grabbed from Martin Armstrong. But here's a 7-year rate of change for real estate. And when like huge base, and when that 7-year rate of change exploded, we have also the silver junior miners where they exploded at the same time. And right now, I don't think we need many months more of real estate going up. And I think it's going to have a momentum breakout real estate, like 1, 2, 3. It's about to break out. So Jesus, hell, when I saw that, I just said, okay, I have to find Andy. What was that real estate thing again there? You have to remind me.
Let's do it.
Yeah.
I'll share this real quick. So here we go. Share. I'm going to first start with the housing starts because this is what's driving it, in my opinion. And what happens in the real estate cycles, you have 4 cycles. You've got the recession, recovery phase, expansion phase, and then a hyper supply phase. And in my opinion, this is what drives the charts that you're looking at. So in the 70s, we had this, and the circles are the commodity to stock ratio. It was throwing a buy signal at the beginning of an expansionary phase, another one here at the beginning of an expansionary phase, and then another one that we're about to enter an expansionary phase. So what I'll try to do it with narrative without looking at the charts too much here.
Okay.
To explain what's driving this is when you go into, and this is the cycle here, recovery, expansion, hypersupply, and recession. When you go from a recovery phase into an expansion phase, and what that means is you've got the average that's going across. That's your average new homes being built per year. That's that long-term average. It's about 1.4 million homes built per year. In the recovery phase, this environment is a low inflation, it's a low inflationary environment with low interest rates. It's the perfect environment for stocks to thrive in. So when they printed all that money at the bottom of 2009, that money couldn't get loaned into the system because it was stuck in the banks. And what the banks did is they just turned around and threw it into bonds and stocks. So if you look at ratios, you notice that everything went into bonds and stocks over that 10, 12-year period from 2009, 10, all the way till today. So this is the environment that money wants to go into. But as the inventory of the homes get eaten up in the recovery phase, home prices start to rocket higher. And that's exactly what you're noticing, is that all the inventories are being drawn down to, we'll call it bare bone levels. It's very hard for buyers to find homes. There's multiple offers on everything that's out there. It means that we have no inventory. And then the next stage is everyone's going to switch their preference to buying new homes because that's all that's available. I mean, that's literally all that's available. So we go into an expansionary phase, which changes the market conditions. So if you think about it, the market conditions are going to change, and that has ramifications on all assets and the pricing of assets in the world. So the inflation driver is new loans against new homes. It's a credit expansion phase. So credit is blowing up as these loans, which are creating money and adding to the money supply, the M2 money supply, these loans are coming into the system that are brand new against new assets, which is 100% inflationary because it's all being created against a new asset. So that inflation is going to put pressure on assets and how assets are priced throughout the world. As weird as this is, the United States real estate market is pressuring the pricing of assets around the world. I know that seems very weird, but when that inflation comes into the system and these assets are all priced in dollars, it's going to put pressure on interest rates to go up. And the movement of interest rates is the fear, the greed. It's going to impact humans a certain way because it's going to force them to do some sort of action. And what I mean by that is if you're a bondholder and you've got inflation starting to go up, but you're not losing any principal or any money, like paper in terms of your account values, people are pretty lazy and they just leave it there. They're like, okay, that's fine, whatever. But if interest rates go up and your values start going down, it's going to put pressure on you to sell. It's going to be like, this is it. I'm done. I can't lose this money. I got to rotate it into something else. And that's where precious metals come into play, because if bonds aren't safe and if stocks, when interest rates go up, they're okay at the beginning of an interest rate move, but it's going to start pressuring them, depending on how fast those interest rates move up, to move out of stocks as well, because stocks are also priced based off of the interest rate. Because the interest rate in your net present value calculation with forward projected earnings, when you discount them back to today, it's going to price these things differently with higher interest rates. So you could have a large rotation out of bonds and stocks into something like precious metals. And that's what we've seen in history. Every single time in history, we've seen this rotation. And another thing I want to kind of add here is we've never seen a blowout crash in an increasing expansionary phase of real estate. It hasn't existed. So all the people who are worried about the crashes, if we're going to get a crash, I think it will be contained to stocks. And I don't think it's going to bleed too much over into real estate. It'll be just like the dot-com bubble. So that was the one time we had a little bit of a recession in stocks versus a blowout recession like 2008, where real estate took everything down. And also like the 1920s crash. That was a real estate driven crash in the 1920s, because it peaked out in 26, started to decline in 27. Things got really bad afterwards, and then everything blew up in 29. Certain markets blew up in 29, certain markets blew up just before it, which is a more information that's kind of cool to chew on.
Well, so when we're vulnerable, okay, so if I look at that graph, okay,
this is the housing starts, and this is the average.
So if we're on the red, we're not. So the red one, the last red one was 2008. Was that it?
Yeah. So this crash, whenever we're coming down on the housing starts and we go below the average, you're going to get a sell signal on your commodity to stock ratio. It's going to probably be high, my guess, because all this money's rotating around. That now, when you go below it, it's crash time. And that's what this recession is in the dark gray line, is a recession. If you notice, here's the dot-com bubble. But every single recession in history back here, the decline in housing starts preceded it every single time, if you notice that. Yeah. So what we're doing is we're coming from, so I'll let me back up here. These red area under the curves, it's under the average here. The bigger the red area, the bigger problem you have in real estate. What happened here is we had foreclosures here and we overbuilt. It was a double whammy. And what happened was we had all these foreclosures come online, and the home builders couldn't compete with these foreclosures. They're like, we can't do anything. They're too cheap. We're not going to sell any homes because everyone's buying foreclosures. So they cut way back on their new home builds. They cut back far too much. And the banks slowly offloaded these things for some years. In 2009, 2010, 2011, 2012, somewhere in that range, we built less homes than any time in history, even once. So we have this gigantic imbalance in the market with too few of homes and everyone fighting for whatever's out there. And whenever you fight for homes, you're going to see higher home prices, and you're going to see rent prices next go absolutely berserk, which we're seeing that in rent prices. So, I mean, that's what I've noticed. And this usually almost always precedes a commodity bull market, is when we get this buy signal and an expansionary phase of real estate. It's like, oh my gosh, this is going to be massive.
And now those are new house starts, right? So this, we're not even talking about, so the used market, we don't care. This is actual new starts. So what does that mean? Like new materials, we need workers. Is that why like there's like a link with even more inflation? Because just a used one is just like switching hands, right?
It's so think of it like these are brand new homes being built, and it could be like, there's also other stuff thrown in there. So it could be multifamily homes as well. So multifamily homes and single family homes all added in here. And what that is it's a loan going against a new asset that's blowing this thing. It's blowing the credit bubble up, so to speak, or credit expansion. So every crash, preceding the crash is a leveraging up of credit. And on the back end is a deleveraging or a shrinking of that credit. It's a destruction of credit. So your money supply will literally go up and down based off of loans in the system, because we have a fractional reserve banking system. There's a whole bunch of charts that you post up, like PPI and other charts, where if you look at this stuff on a big long-term perspective, we're breaking these massive patterns. It's like 40-year patterns, because we had a 40-year decline in interest rates. And that was the Gen X smaller demographic between it. Before, in the 1970s to 1980, that was the baby boomer demographic that came up. And it's a larger demographic. And that's where all that inflation came from, was the housing starts blowing up, the demographic coming through, velocity kicking up a little bit of the money supply, and it's all that spending and new loans in the system. So it's all interconnected. Now, when did gold and silver go crazy? It was back in the 1970s, right? Yeah. And what was so unique about the 1970s versus, say, the 2000s? We had an energy crisis, and we had a housing expansionary phase. And the last kicker, in my opinion, is an increasing interest rate environment. Yeah. And that forced everyone to move money back over. So maybe I'll share one other screen here.
Man, it's crazy.
I still have it.
For years, there was no building in my city. Like we had the fields with nothing, swamplands, whatever. And honestly, right now, since I've bought my house, like that's in 2015, it's insane. Like every single lot. And if there's no building, a restaurant, they break down, they're putting condos up, they're putting houses. It's insane. The quantity of just brand new houses that are being built, like visually, like you see, man, they're leveraging every single ounce of land that's out there. I know I don't want to do like a, what do you call those there when you just see something and then you try to fit it to a narrative, but I am seeing it in my town there.
Yeah, it's a causation.
Anecdotal?
Anecdotal, or correlation is causation, like how they correlate.
But I'm seeing that. And even like my, the municipal evaluation of my house, it's like went up 25% from last year. Like whatever my house was worth, now they're saying, well, now according to the city, it's 25% more, man. That's in 1 year. That's never happened to me ever.
Yeah. So I'll make one last comment. Whenever we're going towards the recovery phase to expansion phase, your inventory goes to very low levels here. And I'm guaranteeing, I guarantee that's what's happening in your area is your inventory levels are super low. And that's when you have the greatest price appreciation of any time, is when you're swapping from a recovery phase to an expansionary phase, that transition. And it lasts a little bit. I mean, this isn't going to be, 6 months. It could be a few years that we're in this transition.
Okay.
And the biggest thing that I think a lot of people don't recognize here is this is an increasing interest rate environment, and this is a declining interest rate environment for the last 40 years. If this turns, if this goes up and breaks this downtrend here and goes into an increasing interest rate environment, all of your wildest dreams that you've been dreaming with silver and gold and all of those commodities, they will come true. Because if you look at history of the monetary base, and hopefully I have got this chart on here somewhere, I'm hoping, if I can find it. It's the monetary base to gold ratio. Nope. I'll find it. Here it is. Gold to monetary base ratio. The difference here is we were in a declining interest rate environment. It wasn't ready. And that's why we had this little move here. It went from 2000 to 2008. And this is gold accounting for some of the monetary base, but we weren't in the right conditions for all of those bonds and stocks to transfer over. If the money transfers over, that is when you get the big cojones boom in the gold and precious metals. That's the revaluation of gold to account for the money supply, because the money supply went into stocks and bonds, and it's going to rotate back over. So I am, as far as I can tell, and even from a lot of the charts that you've showed yourself, you use your PPI to CPI and you use those ratios, you use all that stuff. The PPI is growing so fast and so rapid that I think that interest rates have to follow. Now, there's another thing I want to show. I'm sorry for taking all this, because I love talking about this stuff. There's another thing I want to share here, which gives you more evidence here, because I saw it when I was clicking through here. It was, oh, come on, I've got to have it somewhere in here. Okay, right here. I call it the longest. Oh man, why is it putting both of them in there?
The copper to gold?
Yeah, this copper to gold ratio. If you look at this long-term chart, we're breaking out to the upside. And it's all the way back at 1971. And we're popping up here. And the reason that is important, and I know a lot of people don't maybe think about this, but hold on. I know what I did. There we go. It's this chart right there. See how we've got this breakout here off this big long downtrend? This is from 71. And we're breaking up to the upside. The copper to gold ratio if you look at the correlations in history, it is highly linked to the 10-year yield. Now, I know that kind of goes against here in this beginning portion when they printed a bunch of money and it got all, I think, messed up because they were cheating the system. But now that I think it's all realigned, if this can move higher, it's saying that I think rates are going to go with it because they're highly correlated. So if when looking at some of the deficit charts and the inventories of copper, we're going to have massive deficits in like 2 years. Like it's going to be a pretty big deficit in copper, and it may already have started because we're getting our inventories eaten up. Yeah. So I think if copper outperforms gold and it's highly correlated to the 10-year yield, I think 10-year yields will go higher. I mean, at least if that correlation sticks.
Well, the copper chart, man, it's definitely telling something. And even just the price action of the copper chart, I saw you had it posted there. It's bull flagging right now. So I did a post recently, and if it resolves upwards, it's like we're talking about $7 to $8 copper in like 2-3 months. It's like crazy. Yeah. Like it hasn't crashed copper since then. Usually when you go up fast, it's sticking around the breakout line. It's waiting for something, and it hasn't moved down yet. So you got to give the runner benefit of a chance, and it's done it previously. Man, it's like it's tough to
here's another one.
It's tough to go that route. And I think like that 2001, something happened. Like we seen the charts when gold woke up, and 2000, I think we were kind of meant for us to go back, but something happened. And now it's like in French, they say partie remise. It's like we've stalled all these years, and finally maybe we'll get those long-term rates really tracking upwards for. And geez, I can't even talk about they're so far behind the curve with all the PPI going up and the rates that they're hogging down. I did some like, it's going to take them decades to even catch up and surpass what they need in rates to stifle inflation, right? It's going to take forever for them to catch up.
The rate that what they're going to raise rates, it's so negative right now. And I'm sure you've seen that. I don't know what they're going to do. I think, but here's a long-term chart of the S&P 500 just to show everyone how this stuff correlates. These were expansion phases of real estate correlated to those housing starts, and they were the big consolidation periods through time. So I think what's going to happen is we're going to go into another consolidation period within it could be within a year or less. It's hard for me to say. Calling tops, I don't want to do it because you're going to be wrong the majority of the time. And I think they're in there buying assets as well to drive it higher. I know they're buying all these things with putting stuff on the Fed's balance sheet. It's like, I don't want to touch that. There's no way. But this is the pause points. Now here's let me go to let me see here, copper to gold ratio. I've got it somewhere in here. Here's the copper to gold ratio. And you're talking about that big move and then the pause point here. And this is the ratio, this is just the ratio, not copper itself. But are we going to break here to move this thing up? And if you notice, this is a 40-year decline. Very similar to, and I'm just going to add something here. It's pretty crazy. There's your 10-year.
It's the same.
Your 10-year yield. It's just
the same.
Slanted down. So if this thing breaks and we get a massive move, I don't know what's going to happen with the 10-year.
Jesus, it's going to break. I don't know, man. It's going to be one. Look what it did in 2004-5. Honestly, I've looked at a lot of charts, and sometimes I'm trying to see where we're at. 2004-5 there. Look at, if you bring your arrow there, we're right about that congestion area there. If I could find an analog move, I don't see one closer than that. So 2005, actually, we're right there. So if it resolves upwards,
it's even worse. Like you can just see how well this thing's correlated. Yeah, it's so bad.
Oh, it's crazy. If you type in overlay LPTZ, LTPZ, LPT.
Oh, LTPZ.
Yeah, I'm not quite sure what they are. It's Happy Hawaiian divided
PIMCO
by
15-year.
Divide that by TLT, and so that's going to be the ratio. And
Do you want me to compare it, or do you want me to?
Yeah, just put it a new price scale. Just add it on top, and just that and copper. There it is. And put
just copper.
That and copper, or not even gold. Yeah, that and copper, and they're
right.
Practically the same.
Let me get in there. Hit the wrong button there.
And I have somebody told me that the Happy Wine told me that they're if you do let's say right click or reset chart, and one of them they're all on the same time scale. So move one to the move it to another time. Yeah, right click on that and do move to new pane or move to new. You didn't select the time series.
Oh, there we go. Move to new pane above.
Yeah, there you go. And then you could click. If you put it back in the same pane, and then move to pin to new scale. Sorry about.
No worries. No worries.
Check that out. And the Happy Hour told me that one's heavily. The Fed buys the stuff that.
Okay, one second. We got what was it? It was LP.
Control Z. Right there.
There we go.
And then new price scale
should be in there.
Yeah, I know why. There it is. So right click on that time series and pin scale to scale right below 222. Yeah, that one. Pin to scale. There you go. New pin on the right. There you go.
There we go.
Yeah, look at that.
And that's LPTZ to TLT. Okay.
Yeah, and those are bought up by the Fed. Like I don't know. I don't want to go down conspiracy, but and if you zoom out, that tracks to perfection forever. I don't understand it. What is that about?
I think what's going on is that it's not the supply and demand of commodities that are driving this. It's all financially related stuff.
Yeah,
is what it's starting to come to. And it could correlate with the financial demand for real assets that is driving the supply and demand of those assets. So I think that's what's going on.
So it's all about rates at the end of the day. And when it's not cost effective for people to hold bonds or US equities, the money is just going to rotate naturally into hard assets.
Yeah. And here, I'll take this one off. This is your 10-year treasury yield. And what I've got is a kind of an inverted head and shoulders that's got going on there. And here's like the big long-term picture of it. And we're right there at that resistance line is what I've got. And you zoom in on it, and this is the right shoulder that's going down. And it's like, man, we're just right between these two support and resistance areas. Kind of zoom back out. And we've got on the weekly candlestick a nice big bullish engulfing on the yield. I can't see how this can go down. I don't know how it could.
Yeah, it's
on a long-term perspective.
Look, it's hard to. Sometimes we always want to doubt, but when you see that PPI chart for like 100 years of PPI, and it just ranged for about 10 years. Put the PPI, that one, and if you zoom out, it just broke out of a huge. Look at that, Jesus!
I know it's massive. I mean, this right here scares me a little bit. It's like, I mean,
if you overlay the CPI, the CPI usually lags this chart there. So
this is the CPI here.
So we need the 12. There's a new thing in if you type economics. You found it. Yeah.
This one here, I think. Yeah, United States Consumer Price Index.
Put I want to see the yearly change in that.
Okay.
No, you're right. Yeah, that one's fine. Yeah, so it's pretty crazy there. So that one's lagging the PPI. So if the PPI broke out, that CPI is it's a time bomb there.
Yeah. The PPI is the leading indicator.
Yeah, it is.
So when man, look at this is 2000. You could see the last bull market, but look at what happened here. This is more vertical in a shorter period of time, and the impulse move here is so much greater.
Yeah,
I mean, And what's scary is, you know, Elliott wave, I'm sure to some degree, you've got a first wave, a third wave, and a fifth wave. And this is the first wave, the third wave, and then the fifth wave. So it's one, the third, and then the fifth. What if this is the first wave and the third wave is typically the biggest?
Well,
so, I mean, you're going to have like, I mean, if I can move this over and like scale it. Oh, it doesn't want me to scale there.
Oh, well, because you're on percent. Remove that percent thing. So right click.
Oh yeah, you're right. You're right. I
right
can get
click.
off that.
Go.
Perfect. I didn't even see that. So, I mean, what's really could happen is we get like a little pullback here like this, and it'll have like a little funky thing. And then you're going to see a move like this.
Yeah.
it's like, oh my goodness.
Check, put add an indicator rate of change. So in indicators, type ROC.
We're at up here.
You'll see no, in the indicators FX. Top beside the yes, that one indicator.
There, indicators.
Type
okay, what do you want?
ROC for rate of change. Yeah, the top one, and then pop in 84 in it.
How do you put 84 in here?
In the that one you should keep it in your favorites. But
I see a 9 ROC.
Yeah, put an 84 because that's at the bottom. So you could close that in the indicator that right now you pop. That's 9 month. That's a 9 month rate of change. So yeah, close that one. X. We'll use the top.
Okay.
And click on the little. We'll change the 9 to 84. In the right there in the wheel. There you go. Inputs. Are you with there? Inputs.
Oh, you can go in inputs. I see. Inputs.
84.
Blank,
so we
84.
want the 84 month rate of change, a 7-year rate of change, right?
Yep.
And look at that. This is like powerful momentum. So you're below the zero line, negative rate of change. So that, and now it's I'm going to shivers.
Somewhere in here. It's right there.
When that thing breaks out to the upside, if that's a valid trend line eventually, so we're going to, there's zoom out like this is insane. Like put all the data there. You don't get these signals. Look at the last time you had that signals from the in the 40s you had one, in the 60s 69, and then it started moving up. I'm wondering how that fits with your real estate chart.
Yeah. So
we're nowhere close to a top. That's for sure. We're nowhere close to a top.
No, this is well what this is saying is this is a paradigm shift. Like this is going to be a massive paradigm shift in the entire markets. And what could potentially happen here is a completely different view on how to price assets. Because if your interest rates price assets, and this goes berserk in terms of your inflation, and it's going to change absolutely everything. I mean, it could change your currency and how currencies are. I mean, we may not be on paper currencies anymore.
Honestly, I don't know when I see that there's so much fuel for, and look, that probably tracks it looks like the Fed fund rates are like, you see how that they're trying to, by lowering the rates, they're squishing down. Eventually when that busts up, that means rates have to follow this. They have to, or else it's like negative 20% rates. It doesn't make sense anymore.
Well, the way that I've always viewed it, and maybe I have this wrong, is that rates chase inflation. Rates don't set. Rates chase inflation, and it's a symptom of the scenario. It's not a driver of it. And I think a lot of people say, oh, well, Paul Volcker killed inflation, or did the demographic run out? Because the demographic could have run out and your driver of that inflation ceased to exist. So he just got lucky.
Yeah.
Maybe. I don't know.
Well, I have a tendency to think a little bit like you, because I did a chart and the Fed was always behind they're always behind the curve until the inflation dies out by itself, because high prices, more supply, eventually whatever, all the mechanics that are in there. And after that, he just got lucky. Or if it wouldn't have dried out, that means he would have been raising rates forever. He would have always been behind the curve. Oh man, that would have been insane.
If your driver keeps producing, the house prices would continue higher, and the inflation and money coming into the system would continue. So, because what happens is it goes in cycles with the leveraging up, deleveraging, leveraging up, deleveraging. And then you have these recovery phases in real estate, which are fantastic for stocks. But these small little periods and our leading indicators, I can't find an indicator that's telling me or you or anyone else that we're necessarily wrong. Like there's nothing telling me that, for instance, we've got the expansionary phase coming into real estate. It's just coming up. We've got the demographic in the home buying years that's supporting it. We have low inventories. We've got low inventories of absolutely everything in all of these different commodities coming over the next couple of years. Then you look at the energy crisis that we've got in Europe and Asia. And it's like, wait, energy prices so oil itself is the number one commodity. If it's the number one commodity, that means it's the greatest use of input into this producer price index. And if that has a problem, if we have energy problems and oil eventually has a big problem in terms of pricing going up, this thing's going to go berserk. I mean, it's going to go berserk. And if that's the case, and I look at gold as a how can I say it? It's almost like a bipolar type personality where sometimes it leads, sometimes it lags. It's like it leads sometimes like, hey, we're in a commodity boom. It like raises its hand like, hey, we're going to have one. And then it just cools off for a while, even though everything's going berserk behind it, like oil, energy and lumber and all these other ones that are just rocketing higher. Now those are going to go up. And I think gold's just going to go with it because everyone's going to say, all right, this is for real. Now we got to shift our preference over to something that's going to preserve our wealth in an inflationary environment.
Yeah, for that gold there, what I like sometimes when there's a strong move, there's like a fear of missing out. And I'm wondering gold, like it's quarterly defined or semestral defined all-time highs. I think it's like 1650 or 1675. And gold could have just like exploded up, went above to 2000. And now it's correcting back to like a more meaningful, sometimes like when people look at silver and they look at those highs in the 70s, 50, but didn't stay there a long time or even 2000. So are they really like meaningful? But if you look at more of like a moving average of gold slowly going up. So when it consolidates for a year or two, it doesn't mean that like it's total deflation coming on the corner. It just means that it overshot in exuberance and now needs to let that moving average catch up, right? Until it's forced, somebody forces a hand. Like people say, oh, there's deflation coming up. Gold hasn't gone up. Why isn't it reacting to inflation? But it's they're too close. They're trying to make things move in tandem when, like you said, they move ahead of time. Sometimes they overshoot. They need time to cool down. And like
my thought on that is gold was doing exactly what it was supposed to be doing during the housing market ramp up. And then we had C19, the medical event, which blew it all and chopped everything up. So I think gold got confused almost like, hey, we're getting to go. And then we had that crash. And then afterwards, it's like, okay, we're going to reflate. It priced it in real quick. And then there's all this data out there. Like, what do we do next? I don't know what to do. And I think that's what's going on. Are we going to shut down economies? Are we going to stop things? Are we going to stop travel? And if you look on it, even from a bigger picture view, and maybe this is just a little bit of the conspiracy in me, it's like, did they kind of do this on purpose so they could slow things down? Like, I don't know, but be able to stop things and control things. But here's the Dow Jones to gold ratio. And then we got the rate of change of the 84. And it's like a very close link chart, just because I've seen this chart before. And I said, it looks similar to this. So let's throw it up against each other. So this is the Dow Jones to gold. And I think soon that we're going to see this start to come on down potentially. Maybe. I mean, that's kind of what I've thought, but I've been wrong multiple times there.
The Russell to gold is already since the Russell is like the weakest of the US indices, that's the first one I'm keeping a close eye on. So I think the Russell to gold is already breaking down and we're back testing an important breakdown line. And if I think there's even a strong horizontal. Can you pop up the Russell? I don't know how long you want to keep this, Andy, there, but so RUT divided by
RUT.
Yeah.
RUT divided by
XAU USD, or yeah, gold.
All right.
Well, Owanda's the shortest time series one, so you should try to use the if you want the IDC, you will get more data for gold.
Okay. Well, let's just type it all in. What do you want?
So go back all the way to this. Okay, so RUT, for that was great. The one you chose, the TVC is the
you said
then
TDs?
XAU USD. But with your arrow key, go down to IDC. Yeah, that one.
This one.
There you go. Yeah. So now we'll get more data. And
all the
that
way to
one,
88.
Yeah. So if that breaks to the upside, you want that momentum. So the momentum is weak right now. It's if it crosses below the zero line, it's a commodity heaven. So that.
Yep.
So right now it's not doing a new high. So the Russell nominally hasn't done a new high versus gold. It hasn't done a new high since 2000 versus gold. Actually, the Russell has peaked when measured in gold. It just went sideways for 21 years, right? But you want that rate of change. As soon as it goes from above zero to negative, that 7-year rate of change, we're in a bona fide, I don't know, the rates are going to have to go up. Like we're very close there. So it's a lot of weakness. So even if nominally that ratio has been going up, the 7-year rate of change hasn't gone up as fast. So you're like going up a hill, but instead of running up the hill, you're walking, man. You're walking, and slowly you're just going to exhaust yourself and just roll back down. So we're close to that. So even if the US equities nominally, they still look super strong, they're losing a lot of steam.
I agree with that.
Look, in 2004 did the same thing. So it broke down in 2000 and it almost tried to go back up. But when you look at the rate of change was refused to go up. Even on that, when the Russell tried to overcome its all-time highs versus gold, the rate of change was still, no, I'm sorry, you're not going up fast enough. You're losing steam. Capital flows are leaving. That's how I rationalize when I see the stuff there. So
yeah, and what happened here is we threw a buy signal in commodities in 98, 99, which was up here. That was the buy signal. We threw one earlier, but it stayed low because of C19. You can see a high, a lower high, and this thing just rolled right on over. And then this is when the real estate crash, it was starting to crash in 07, 08. The housing starts dove, and then the whole market really dove out after in 08. So I think, just by looking at this, I think we wanted to go in 08. And if you look at, let me pull this up, in 08, let me get this off here. In 08, or 2018, I mean, not 08, 2018, we were breaking out. You see that? And then we had a bunch of problems, which is right there. So we're like, hey, we're ready to go on a commodity bull market. We can see it in this chart that 18, it was starting to come back.
Yeah.
And then they had the C19 event and all this other stuff right after that, because I don't know.
There's even like a breakdown line, and now it's just a retest. You could probably
here?
Yeah, so if you draw a line from that through
you're talking like this guy here?
No, from the right hand side, but draw it under that there like the Jesus, gonna be tough.
Right here, some in here. Well, retest means you're coming back and going to retest something.
Yes,
right?
Yes, that retest. So there's a breakdown line right below. So that 2016 trough, that's going to be part of the lower. Check out. There, draw line there.
Here, huh?
Yes. Yeah. There we go.
Gotcha.
It looks like the US dollar also. So there's one there,
yes.
and from 1990 all the way to 2000, you have another one there. You could kind of stretch out. I think that's the same type of scenario we're having. So from
I agree.
It's just like a retest.
Exactly like the dollar. I mean, to the T, because the dollar's got one right here that I already drew.
There
in.
you go. Same thing. They're all linked, these charts. Like you said, everything's financialized since 1971 or whenever. And yeah, as soon as it's not worth, like they're all going to roll over together. All these charts there, they're all the same. And the more I look at them, Jesus, they're all the same. These charts, like there's a few key charts, but after that, they just pile under. Like, okay, put that in that chart category. You look.
I'll show you a cool one here. This is Newmont Mining. Let me zoom all the way out. This is from 1978. And look at the pattern it's got here. This is a huge consolidation pattern from 1978. Now, we were looking at that PPI, the producer price index. And what I'm trying to do is correlate this. If the PPI here is going vertical like this, let me get back out. Let me lose this. Delete the pane there. Let's go back to all auto. If each of these periods in between were I would say very good periods to invest into precious metals, because this was all the way 68 to 81, and this was a huge boom. I mean, if we have this coming up, minus, I'll take this out because I drew that in there. But we have this going to the upside, and we've got, I'm just using Newmont as an example. We've got Newmont on a big, large scale lining up a massive pattern like this, ready to break to the upside at some point. I mean, this is all basically interconnected, what you've said, and it's ready to go at any point. I mean, it may take some time, but these moves will be so big and so ridiculous that there's no point of not getting in now and cost averaging in and just kind of holding on through this.
Yeah,
I don't know why you trade.
It's going to go to a new plateau. It's like you see it in like, let's pop the copper chart. Like it's just higher and higher. HG, or do you have the long term?
Right here,
I'll
just type it in. HG1, I think.
Yeah, I have an even better one. I'll give it to you. Hold on. Where's my?
This guy here.
Wait.
That's my drawing on it.
I have a good one for copper that gives
here,
data.
I'll stop sharing. You can share if you got it.
Okay. Check it out. Share screen. Share. So here I put all these quantiles where you have some data feeds that are a little longer than. So this is the copper chart since, I'll put my 7-year rate of change. Reset. Oh, okay. Look at copper. Look at the rate of change for copper. Barely. So here's my lines. Okay, this one I put on. Geez, they're like plateaus. So I'll put it on. I'll remove log, and there's like these. Here is like a plateau that huge move, like consolidation, broke out through like I think where we are today. Then a new I'll just remove all my drawings. Okay, I'll put it back on log. Click, reset chart. Yeah, okay, we'll see. They're like just plateaus. And I have a feeling that we'll never see these numbers again. Once this is like essentially going to, once we bust above that, I think we're just going to go have fun for another whatever there is. It's just, Jesus. Like
one thing when we look at like Elliott wave too, is if you, the lead in there on the bottom, this could be impulse 1. We had a consolidation period for a little bit, and then we have got impulse 3 coming. Yeah. So the big move between the two boxes would be an impulse move 1. And we're starting wave 3 because it looks like that in other patterns that I've seen where like oil, for instance, oil is going to do something ridiculous. I don't know how high it's going to go, but I look at the big pattern and it's like, oh my goodness, this is going to go absolutely ridiculous.
Yeah.
And if it does that, it impacts everything. It'll impact copper. It'll impact commodities because these have high energy input costs. And they're very energy intensive.
Same thing here, a box, new plateau, even if it's exotic, it's overshoots, upwards, downwards. It's once we bust up in this new box, it's going to be a new, sometimes I like putting it on the yearly candles to reduce noise, but yeah, it reduces some noise there when you put it on the yearly candle. all the candles.
What is PCOPP? What is that? The
Well, that's my ticker. So I get it from QuantDL. If you go on QuantDL, I have a whole bunch of data series that aren't on TradingView, and that's just the ticker, the vendor who gives you that data series for free. Okay. Just if you put that in, you get data.
What is the PD? What is the PCOPP though? What is that?
Copper.
Is that the copper? Okay, I got you.
So I just don't I don't know exactly what. See that the numbers. Is it spot copper? I'm not sure, but man, look at these patterns. Like if this breaks out, even on the yearly close, look, we're this could be a yearly close above all-time highs, and that is meaningful here. The yearly close in 2005. A lot of similarities between today and 2005. And here, Jesus.
There's a really big difference here too in the market conditions that I don't think a lot of people are thinking of. The dollar has remained quite strong because other currencies have been very, very weak. And I think what's going to happen is if commodities outperform in dollar denominated currency, then everyone in the world's going to run it at commodities and blow this PPI and CPI. It's going to blow everything up because what they're going to do is they're going to say commodities are outperforming the dollar and the dollar is outperforming my currency, which then means that it's going, this is crazy to think of it. All currencies will want to go into dollar denominated assets, but if commodities are outperforming the dollar and interest rates start to move up, it blows everything up into commodities because even your bond market and stock market will start to rotate in. So it's this like gigantic, if you have any money in any of these things that you're just kind of sitting there with, waiting for this big rotation to happen, the risk reward is so large. I don't see how it wouldn't play out. It would play out so great that just having a little bit in there would be great.
It's gonna be huge. We haven't had honestly when we start leaving the further, because trend lines, like they give you a long-term angle of a trend, right? With the further you are stretched from a possible trend line, or eventually three touches or more, you have a trend line. Each time you get stretched, there's fear of missing out, and that's the worst time to buy because usually there's a reversion to that long-term mean. Yes. These opportunities, when you touch an inclining trend line like that, the further you go away, it's too you're not going to get great returns on your investment. Like buying here, you're stretched, right? You have chances of having moves down to try to retouch that magnetic line. So this 2020 was the last greatest chance. And if we close above this neckline, man, it's like we could be having 3-4 years in a row of just copper, just never looking back. Never.
Yes.
Look at that. Look at Jesus. So
yeah, the way that I've been playing it is with royalty companies, because I'm trying to take the input costs out of it. So that's kind of how I always have viewed it.
Oh man, this is huge.
It's ridiculous. It's because you're looking at this from a yearly candlestick perspective, just to make sure everybody understands that. And it's all the way back to 81 or early 80s.
80, yeah.
And it's stair-stepping from one level to another level. And what we're saying is that it's going to stair-step to some whatever level above that.
Yeah, could do where's my copy tool? Yeah, I could don't know what the hell's gonna, I don't know.
Yeah, you could throw that right. Well,
no, I didn't grab the good place, right?
Yeah, if you place, there, that bottom or whatever.
Yeah.
Something on the lines.
Yeah, that would make sense. And 2024, we're expecting a mid-cycle low. So that could be something also plausible, a retest of that breakout line before exploding higher. So who knows, man? But it's not bearish. I don't understand. How could you have a yearly defined close, all-time highs be bearish? I understand bearish scenarios can happen, but why are you looking at, we're not hogging this line to the downside. We're hogging a breakout line. Why live in fear, guys? When I hear these guys with these crazy scenarios, okay, let's say there is deflation. Okay, well, let's at least wait. Can we wait for this trend line to break downwards or get challenged? It's the opposite happening.
So with the data that we have, I would say that, so the charts are millions, well, it'd probably be hundreds of millions of people interacting with each other, creating these charts. And what we're looking at is raw data in a chart format. And if we hit these, we'll call known reliable chart patterns, the market is literally telling us that we are not going to have deflation by looking at these charts.
Well, the probabilities are much lower. And if there's a deflation event, it will be short-lived. So let's say deflation for me is like negative, what is it? Negative inflation. So if there's one, it's going to be like super temporary, like 2008 and whatever, it's just going to vacuum back up, you know? So but I don't think there's no meaningful long-term deflation anywhere in the cards. Like not when you see a copper about to break out. I've never saw this yearly copper chart before, man. I'm going to have to post on it because it's epic. Well, and especially we're getting close to the December close.
Copper is Dr. Copper is the market telling you that you're going to have inflation or deflation. Same with the copper to gold ratio and the relationship between those two assets. And same with platinum to gold, because if platinum outperforms gold, the inflation sensitivity of platinum it's baked into the cake. It's the market telling you that you're going to be in an inflationary environment with that ratio. Also in 2008, we had a real estate crash, and you could see that crash before it came through the housing starts in real estate, because it dove way down, and it's like, we see it. We're doing the opposite. We're about to launch to the upside. And I was looking at an article with an analyst in the real estate sector that's digs way into this. His projections over the next 10 years says that we could build at 2 million homes per year for the next 10 years, and we would barely satisfy the demand. And what that means, and I'll just pull that up to give you guys, you know, what that exactly means here. Let me share it real quick, because it's absolutely ridiculous, because the further you go above this line, the more inflationary it is. What he is saying is that we could go to 2 million, which is about the same as the late 70s, and do it for 10 years. That would be from 2000 to 2010 in this big duration here of what's coming up, and we would still meet that demand. It's so big and could be so inflationary that I don't think people, that they don't grasp it. And this is what, in my opinion, drives it, because you can see the recessions all were on the decline of real estate. So I don't know. I'm trying to find data to dispute this, but I can't find anywhere that correlates or does anything. So I'm long, I'm in, and I'm just holding on. I'm not trading in and out.
Well, that's the hardest thing, because these moves, these high probability moves, like you see, like I'm always dealing at the smallest, like monthly, quarterly candles. So even if the market needs a little bit more time to gyrate, it's a lot of time, like of my life, you know. So let's say we're off by 6 months, or even let's say 6 candles, and you're on quarterly candles. Jesus, that's a year and a half. So maybe this thing will take off like really seriously in 2024. Who knows, you know? But forgetting time from a reward versus risk profiling, we're living a turn. We're living 99, 2000, or let's say 98, 99, 2000, 2001. We're living this type of turn that is going to happen one time in your life. So either you go all in on cryptos or close to a top. But from a risk versus reward profiling, the data is showing you that this is the time to accumulate and just ride this thing for 10, 20 years. Like we all have different profiles. Like we're not financial advisors. And like at my age, I'm 45. Like for me, this is fine. You know, I have time on my hands to play this out properly, you know. I don't want to be like I started like in 2006 playing the markets and doing TA. And in 2008, it crashed. And then I was doing stage analysis. And in 2009, I was getting a lot of buy signals and I was buying, but I was living in fear. Oh, what if there's another crisis? And my stocks would do one bagger, I would sell. But in hindsight, I'd look and Jesus, Patrick, man, you sold so early. It went 10x your cold company that you sold. And I said, no more. So as long as this big picture stuff, I'm not going to let daily volatility like get me out of this concept. When all the stuff starts breaking down, let's say copper starts breaking down, but on the long term, like the rate of change starts breaking down and all the stuff starts like, okay, but until that happens, I'm not going to let, like, Jesus, you can't miss this move that, but it doesn't mean go all in on this, right? If guys want to do other stuff and they want to play trade or do whatever they want, to be millionaires overnight, fine. But I want to be able to say, I rode this out from the start to the end. I have a chance. Like, I'm young. I could still do it.
I'm the same exact way. I was trading in and out on the last bull market of commodities. I'm 40 years old. So I was towards the tail end of it. I didn't know what I was doing. I'll be honest. That's fine. I was jumping in and out. I was trying to be someone I wasn't, probably, I just didn't know what I was doing. And I was using a little bit of margin. I was doing some short-term trading. Sometimes I made a lot of money. Sometimes I didn't. But if you catch the big move with a lot of money, oh my goodness, this could be like the 70s more so. And I say the 70s only like 40s to 70s to 50, somewhere in that range. The only reason I say that is because I think interest rates might propel this to be different than what it was in the 2000s to 2008. And maybe it doesn't. Maybe I'm wrong. Maybe it turns out to be a 2000 to 2008 type move. But even that 2000 to 2008 move was massive. So I'll take either one. And you only need, I think we'll get maybe 2 or 3 in your lifetime. That's all you get. Because the cycle is 8 to 10 years up, 8 to 10 years down, 8 to 10 years up. So the next cycle, and I know a lot of people always ask me, what's next after commodities? I'm like, well, that's 8 to 10 years away or more. But the next cycle would be, you get to a top, you'd want to go into bonds, you get a crash, interest rates will go down, you go up, and then you swap into stocks at the bottom. That's kind of the rotation that I see, but that's a long ways away.
And that's great hearing that, because often people, they associate commodity bulls with gold bugs and I'll never change my mind. But no, guys, when the data flips, we'll buy whatever we need to buy to preserve our wealth and even make more. But the earlier you get, it's like any stock guy. If you get a stock at $1, it's going to be a lot easier for a 50 million market cap to go to 500 million. Nobody's going to blink an eye. You'll make a 10 bagger. But the further you get in, let's say buying Bitcoin at 60. Sorry, I'm not picking on Bitcoin, but let's say you buy at 65, then you're just praying for a double. What? You have to go to 120,000. It's like the risk versus reward. Bitcoin, you had to buy at 9,000 when it broke out. Guys, don't aim for 1 baggers, aim for 8 to 10 baggers, but you need to get those at the beginning of a cycle. But the price is time, right? So if your timing is not perfect, then, but that's what you need. You need to get in super early when Barrick Gold in the 1980s, whatever, it was $1. That's when you get in Barrick Gold, not at $40, $50, unless it's ready for a next leg up. But
here's a question that I'll have for you. And I can answer this too, and we can share our opinions. You say to buy it when it's really low. How do you have the confidence? Because a lot of these have been scraping the bottom for years. Yeah. How do you have that confidence to know that it's going to eventually turn and go up? What signals, what data, what gives you that confidence to buy it when it's low, but hasn't moved yet? What makes you think it's going to turn and turn up? Because everyone, what they do is they use price as a justification to buy the stock. And what you're doing is you're taking that price justification away from them. And you're saying you gotta trust and buy it low, but you could buy low companies that stay low for a very long time. Yeah. What do you use, or how do you gain that confidence outside of maybe joining Bad Charts or North Star, and getting a subscription there? But what do you do to get that confidence? Like what do you look at?
Well, that's when the TA comes in. So you want to be, I don't know, a sufficient time frame enough where it's a meaningful turn. So let's say on the monthly chart, you have higher lows, you have those arcs. So let's say you went down, you did a base for 5-6 years, and then you're starting to carve in really higher lows on the monthly candle chart. You're above a 1 year and 3 year moving average. Especially at the beginning, let's say, of a 1 year and 3 year moving average bullish cross. And if, let's say, there's a retest and you break above a horizontal line, that's it. That's pretty much the lowest risk, highest reward you could get. But you're right. If you're below the 1 year moving average or 3 year moving average, you're below a horizontal monthly defined breakout line. You're right. It could drag on for a long time. So you want at least, usually off the bottoms, there's going to be at least a 50% move, because you need price action to move up, to start trending up, to start, like having a positive vicious cycle. So I'd say the sweet spot for me, the low risk chart setup, and you guys go through my Twitter. It's a 1 year and 3 year moving average. Get a golden cross there. And then on the retest of the 1 year or the 3 year, usually those are the low risk entry areas that you could get. Yeah, you can't just buy low. You're right. That makes no sense. But as chart traders, you could have evidence building that helps you situate that. And now, since like we've seen those gold to US equity ratios that haven't completely turned yet. So a lot of these, there's always like leading mining stocks are super powerful, like Kirkland that kept going up even in the bear market. It kept going up. But the bulk, so you could start getting it early now, getting those, I call them the relatively strong stocks versus their sector, which hasn't overcome, like the rates aren't up yet and they're still doing good. But imagine when the macros will really start outperforming the Dow and the rates start going up, then you'll be able, a lot of more of these ones that were flatlining, they'll start going up above their 1 year and 3 year. And you'll be able to, you could wait for that if you want, actually. You don't have to like go all in now. And even going all in now is probably not the best thing, because you really want to make sure that those macro tidal wave ratio charts really turn in your favor, like that copper chart that's about to break out. So if you just wait on that 7 year rate of change for copper to break out above that line, there's leaders and laggards. And as the bull market moves on, you'll get less and less to pick and choose. Right now, we have an abundance of choice. So the best ones are going to start breaking out. And in the mid cycle, like there'll be a whole bunch that are going to start breaking out. Towards the end, there won't be any more, right? But super early. I don't know if I answered properly, but there is ways, with chart trading to not get in too early.
Yeah, the one thing I look for is a big downtrend, and then I see a flattening accumulation period, and then I look for higher lows stepping up into a line, and then I just say, hey, this thing's going to break, and then I look at the ratios to verify that the money is not there and that it's cheap. That's all I do. And then I look at.
It's that simple. It's like somebody could do Elliott wave, somebody could do chart trading, but it pretty much is like that, right? A downtrend, the bigger the base, the higher in space. And as soon as you start getting out of that base, it's time. You look at any of the charts, guys, that had huge returns. Tesla had a big base before as soon as it exploded, it never looked back. Don't buy it. When you look at a chart, guys, and you see it's like a vertical, the line. Even if it does go up, it doesn't mean it was correct to buy halfway through. That was wrong. You had to buy when that base breaks out. And
then I think there was one other thing I was going to say. This is good for commodities where companies don't control the selling price of what they sell. If a company controls the price of something that they sell and it's in a huge downtrend, that may not be a good one to buy because they can control what they sell. So I don't, this doesn't apply to some other stocks where they're in massive downtrends and they're literally going bankrupt. We're talking, at least when I talk, it's about commodity companies where they don't control the selling price of what they sell. They are good, solid, well-run companies that went into a unfavorable environment and going into a more favorable environment.
Because they track the underlying commodity moves of these charts. You could overlay them to whatever they're selling, and they pretty much look like the underlying company, right?
Yeah. And I got a question for you. What's your favorite sector? Just for the heck of it. What sector do you like the most? And which one do you think has the best risk reward?
Well, right now, silver, because I research it so much, but from a risk versus reward, silver right now, so close to its 3 year moving average. Having gold, since it's like the twin sister of gold, and I know that gold, whenever gold does a new high, silver always does a new high, like eventually, man, that's like for a confidence hold, to buy silver right now, close to its 3 year moving average, around, I don't know what, that for me has the most enticing risk versus reward profiling. I know there's other ones, like eventually even the silver to platinum ratio chart, when that breaks out, that platinum is going to go ballistic. But I got to say right now, silver for me, like, Jesus,
That's
man.
your favorite?
I get so many trolls and hate that I can't be wrong.
I'm the big energy bull at the moment. So I'm very heavily into oil and uranium and natural gas. Those are the ones that I prefer at this moment.
Yeah, they've all had 6-7 year bases, man. Jesus, how could you go wrong like with that type of in natural gas? I think even more. Yeah, oh man, it's gonna be one time I did a chart where I put all the commodities on one chart, and they all get their turn to flare up, man. Like lumber flared up, sugar flared up, coffee. They each get their turn. So just pick and choose one that hasn't gone ballistic yet, and eventually I'll get a turn to dance.
My reasoning is if Europe's blowing to the upside and Asia's blowing up to the upside in natural gas, that I could just go buy the laggard of America and wait for that to blow up next. That's kind of my thought process.
Yeah.
So
the crystal balls are in the other countries, like gold that was breaking out against the Canadian dollars, Australian dollars, like 6 months before it did in the US. Then you had an arbitrage play eventually with anything denominated US dollar. So as soon as the DXY showed weakness, then those commodities, you had a good play there. Oh man, it's been fun, Andy, talking. We're supposed to talk 2 minutes and we did an hour.
I know. I love talking about this stuff though. I really do.
Same here.
And I like getting your perspective on things and getting your perspective from.
But we're a nickel bubble, Andy. We shouldn't do this, guys.
Well, the only thing I'll say is we've got a lot of money that's been printed in the past 18 months. I think a lot of these assets haven't accounted for it. So that may be a perspective that people aren't looking at it from.
Yeah.
Maybe.
When it's too good to be true, it's true, guys. Sorry.
Do you have anything else? Any other comments or questions or?
No. Well, let's touch base again there. It's I learned something new there every time there. I start deep diving whatever somebody else is doing, and I say, oh, look at that relationship. Like I just have a certain amount of time in my day. Like I could discover a whole bunch of things, but then when you take a step out, you say, oh, look at that guy. He's been working with, and he has crazy research, and look how that links. Like I always say, like a scientist doesn't start cancer research from scratch, right? They build on stuff that's been built before, right? So I think as a community, I'm happy to see like we're trying to meld stuff together there. And if ever silver's at 100 and I say, oh, it's going to keep going up, I hope you give me a call and say, Patrick, it's over. Sell. It's over, Pat.
No, I'm gonna give you a call and say it's got another 10x on top of it.
Oh boy, Jesus!
Don't sell. Man. No, I think we'll get our signals. Don't worry, and hopefully we can share that with everyone. So they can all participate in this big bull market and get out. Hopefully with some. What I'm going to do is cost average out slowly. So I'm not going to try to time this exact point where it's like, oh, I got it, and then all of a sudden it runs up again. It's like, nope, just slowly leak out. The ratio's high. All our stuff's rolling over. I'm just going to leak things out.
Yeah, that's the best way. Actually, just like now, people could just slowly average in instead of trying to guess the bottom. Just go in slowly. There's no rush, guys. You're on monthly or quarterly candles. It's not the end of the world. Like just do it slowly. And if you're not over leveraged, this is going to be a breeze. For you guys that are over leveraged and want to be millionaires overnight, you're not going to make it, guys.
Yeah, and another thing that I see that's very similar between you and I is we went short term in the beginning, and then we lengthen our time frames, and then we go for the larger and larger returns over time.
Yeah.
And anyone who's been in the market for a long time, they seem to do that. I don't know why, but it's just more reliable, it's less stressful, and it's far more gains than it is trying to get these little 50 to 100% moves at best.
Well, you must remember, like I couldn't sleep sometimes at night. Like I had too much over leverage, and then the next day I sold. Like I said, and that's not good, man. Your health is number one, and you're right. These big long-term trends, the position size is much smaller, but the over time you'll get strong gains without stressing yourself out and enjoying life with your family instead of spending time with your kids and you're stressed about your investment. What the hell is that about? Like I don't want to do that.
And I will say this though, there is opportunities even in these long-term moves where you can make 20 times your money in 1 year. Cause I did it last year with SM Energy.
Yeah.
I was like, oh my goodness. So there are opportunities out there to do 10 bagger pluses in a span, but you have to be at the bottom. You have to know what's good value. You have to look at the charts. You have to make sure that this stuff's bottoming out. The volume is stepping into it, and someone's coming in back in this company and ready to push it up. So
I'm getting shivers, man. I'm gonna buy stuff tonight. I have to buy stuff.
I just hold on and I leak stuff in really slow.
Yeah.
So you have anything else or anything else to add?
That's it, guys. Bad Charts 1 on Twitter, northstarbadcharts.com, and I hope to talk to you soon again, Andy. There, it was a real pleasure. I call you Andy, but Tom from Palisade, he called you Andrew. What's that about?
Either one. My most people call me Andy, but obviously my full name's Andrew. And you can find me at @finding_finance on Twitter. And sometimes you can see us going back and forth, retweeting and liking our stuff. Yeah. So, all right. Well, thanks for coming on, Patrick. I really appreciate you and your time. Thank you.
Thanks. Same here, man.